Holding companies, what they are and why they matter for business owners. If you run your own company, be that a trading or an investment company, you've probably heard someone mention the idea of a holding company to you before. You might not be 100% sure what it is or whether you even need one, and that's fair. A lot of people run successful businesses for years without ever setting one up, but miss the benefits that it can offer. In this video, I'll break down what a holding company is, how it works, and why so many business owners are looking at this structure in 2025, especially as they start thinking about protecting assets, growing wealth, or just planning for the long term. If you're new here, I'm Abbas, chartered accountant and chartered tax advisor. I trained at one of the big 4 firms in their private client team, and now I work with business owners and individuals on UK tax, structuring, inheritance tax planning, and family business strategy. This isn't personal advice, but it should give you a clearer idea of what holding companies do and whether it's something worth thinking about for you. Let's get into it. Most people start by setting up their trading business through a company, and then they grow that business. Say you're on a consultancy, e-commerce store, dev agency, property business, and everything goes into that one company. You trade, earn profits, take out a salary and some dividends, pay your corporation tax, and maybe leave some of that cash in the business to reinvest or save later on. Now, in many cases, if the business does well, it starts generating more profit than you actually need for your personal expenses, and you start building up retained profits and cash within that company. So the question becomes, what do you do with that money? Some will look to diversify, maybe buy a rental property, invest in another business, or maybe even into stocks. While that can make sense, there's one issue. All of that value, all of those new activities are sitting in the same company as your trading business, which means they're exposed. If something goes wrong in the trade, maybe a legal dispute, maybe something outside of your control, all of the value is at risk. Someone could make a claim over your investment property because of a dispute in the trade, or vice versa. And that's where a holding company can help. A holding company is just a company that owns other companies. So instead of you personally owning the trading company, you set up a holding company, and that becomes the shareholder of your trading company. You then own the holding company. From a day-to-day point of view, the trade keeps running the same way. You still manage it, you still pay corporation tax, and you still make the key decisions. But now, when you want to move money out of the trading company, you don't need to take it out personally. The company can pay a dividend up to the holding company, completely tax-free, because dividends between UK companies are not taxable. And now you've got cash sitting in the holding company. You can either make your investments there, or set up a separate investment company under the holding company and move the cash into that company instead. The result is that you still get to invest in whatever you wanted to, property, business, stocks, but crucially, property is now sat in a different company to the trade, meaning it's protected. While the key benefit is asset protection, using a holding company also comes with some major tax advantages. Once you've set up a holding company, you've probably created a group for capital gains tax purposes, meaning you can move assets from one company to another within the group without triggering any tax charges. That means you can move properties, loans, or cash around as needed. You can also use group loss relief. So if one company in the group makes a loss and the right conditions are met, you can offset that company's loss against the profits of another group company. If you sell the trading company one day, the holding company may be able to benefit from the substantial shareholding exemption, meaning the gain is tax-free on sale. Holdco pays no tax on the gain, and it can then reinvest the proceeds fully. But if you had owned the trading company personally, you'd be paying CGT. If you're just starting out, the best time to set up a holding company is from day one. It's clean, simple, and avoids the need for restructuring later on. That said, it's not the right answer for everyone on day one. If you're starting small and you're not looking to do anything other than your core trade, a holding company just adds more admin for you. But if you've already got a company that's trading and building up value, it's not too late to restructure. You just need to do it properly and get tax advice so it's done on a tax-neutral basis, i.e. there's no tax due. That usually is done through a share-for-share exchange, where you swap your shares in the trading company for shares in the new holding company. Done right, it's tax-neutral, but it does require HMRC clearance and the proper steps taken. One thing I see fairly often is when someone sets up a second company, maybe a property company without a holding company structure, then loans money across from the trading company. Technically, yes, you can do it, but it's messy. From HMRC's point of view, loans between close companies, especially where one person controls both, are getting more attention. And if that loan ends up benefiting you personally, or isn't on arm's length terms, you could face a tax charge under the Section 455 rules. That's normally aimed at director loans, but HMRC has already published guidance suggesting that these kind of intercompany loans could be within the scope of this in the future. So while it might work now, it's not a future-proof structure. A proper group setup with a holding company avoids all of that risk, and it gives you a clean and compliant ways to move funds around and grow. In terms of downsides, there's a bit more admin, another company to maintain, another set of accounts, and maybe a confirmation statement, but that's relatively minor. where you've got large investments in the group, say rental properties or share portfolios, it can also affect your business property relief position for inheritance tax. That's where it might be worth looking at setting up Alphabet shares or setting up the holding company as a family investment company to help manage IHT exposure over the long term. The holding company isn't something you need just because everyone's talking about it. But if your business is growing, if you've got retained profits, and you're thinking about the long term, it's definitely worth looking into. It gives you more protection, more control, and more flexibility. And if you're looking to reinvest, de-risk, or plan an exit, this is one of the cleanest ways to do it. We help clients set these up all the time, properly, cleanly, and with the wider picture in mind. If you're thinking about it, feel free to get in touch. That's it for this video. If you have any questions or if there's a topic you'd like me to cover next, drop a comment below. If you found this video helpful, don't forget to like and subscribe. It really helps support this channel and I appreciate it. Thank you for watching.